What if the very retirement account you diligently contribute to is quietly eroding your future without you even realizing it? Is your RRSP secretly costing you thousands, potentially hundreds of thousands, year after year? Today, we're ripping back the curtain on the hidden costs eating away at your RRSP wealth, and I'll show you exactly how to identify them and protect your hard-earned financial future. After years analyzing Canadian financial landscapes, I've witnessed firsthand how these subtle drains can devastate retirement plans. Did you know that seemingly minor fees can collectively shrink a typical Canadian RRSP by well over $250,000 over a few decades? It's a sobering thought, isn't it? Have you ever truly scrutinized your RRSP statements for more than just growth numbers? Let me know in the comments below. You've been told your RRSP is your secure path to retirement, a tax-deferred haven for your savings. You contribute diligently, believing every dollar is working for your future. But what if I told you there are invisible forces chipping away at your money, like a slow, unnoticeable leak in your retirement bucket? Many Canadians are shocked when they uncover the substantial amounts they're paying in fees buried deep within their investments, or that their tax-deferred savings could surprisingly lead to a massive tax bill later on. It's a reality few prepare for, leaving many feeling blindsided when retirement finally arrives. This silent erosion of wealth is a serious threat to your financial independence. Today, we're not just shining a light on these issues, we're diving deep into the 10 most shocking hidden costs of your RRSP. From the notorious MR monster that silently devours your gains, to the surprising retirement tax trap that can ambush your golden years, and even the often overlooked cost of inaction itself. All reveal these silent wealth destroyers and, crucially, give you actionable steps to combat them, ensuring your retirement savings truly work for you. Let's start with one of the most pervasive culprits, yet one many Canadians don't fully grasp. First up, the Management Expense Ratio, or MR. This is the total annual cost of managing and operating a mutual fund or ETF, expressed as a percentage. It might seem small, say 1.8% or 2%, but this percentage applies to your entire investment and, crucially, it compounds over decades. Think of it like a persistent drip that, over time, can empty an entire reservoir. Imagine you have a growing RRSP of $120,000. A 2% MR doesn't just skim a little off the top. Over 25 years, it could potentially strip away over $60,000 in lost growth compared to a fund with a significantly lower 0.4% MR. That's a massive chunk of your potential retirement nest egg gone, silently year after year. To protect your wealth, always check the MR of any fund you consider. Opt for low-cost index funds or ETFs with MRs well under 0.6% whenever possible. By minimizing these fees, you radically boost the power of compounding, keeping significantly more of your hard-earned money right where it belongs, in your retirement fund. But MRs are just one piece of the puzzle. What if you're paying even more without realizing it, directly to someone you trust? This brings us to advisor fees. Beyond the MRs buried in your funds, you might be paying direct or indirect fees to your financial advisor. This could be a percentage of your assets under management, or perhaps commissions on specific products they recommend or sell. These fees often go unnoticed because they're typically debited directly from your account, never hitting your bank statement as a separate charge. Consider an advisor charging 1.2% on a $250,000 RRSP portfolio. That's $3,000 annually. Over 20 years, without even accounting for lost compounding, you've paid Emphasis $60,000 just in advisor fees. This isn't small change. To protect your finances, ask your advisor for a crystal-clear, full breakdown of all fees you're paying, both direct and indirect. Don't hesitate to question their value proposition. For many Canadians, exploring fee-only advisors or, if comfortable, managing a portion of your portfolio yourself with low-cost options can make a substantial difference. Understanding and negotiating these fees ensures you're getting true value for the advice, preventing significant wealth erosion. But even if you master fees, a bigger tax monster could be lurking around the corner. Let's talk about the retirement tax trap. While your RRSP contributions are tax-deductible now, every dollar you withdraw in retirement is taxed as regular income. Without meticulous planning, this can easily push you into higher tax brackets during your golden years. And here's the kicker for many Canadians: it can trigger Old Age Security or OAS clawbacks. Imagine you've saved diligently, but withdrawing a large sum from your RRSP in a single year pushes your income into a higher bracket, meaning you might pay 35% or even 40% in taxes on that income. On top of that, if your net income exceeds certain thresholds, which change annually, but for 2024 it's around $90,997, your precious OAS benefits start to be reduced or clawed back. It's like working hard to build a comfortable retirement, only to have a portion of your benefits silently disappear. The solution? Develop a strategic withdrawal plan for retirement. Consider income splitting with a spouse if applicable, and carefully balance RRSP withdrawals with other income sources like TFSAs or non-registered investments. Optimizing this strategy can save you tens of thousands in taxes and protect those vital government benefits, ensuring a higher net income and a more comfortable retirement. But what if you're managing your own RRSP? You might think you're safe from hidden fees, but think again. Even in self-directed RRSPs, where you control your investments, hidden trading and maintenance fees can silently drain your portfolio. We're talking about trading commissions, inactivity fees, transfer fees, or even foreign exchange fees when you're buying US dollar assets. These might seem like small charges individually, but they add up rapidly. For example, if you frequently trade stocks, paying just $8 per transaction for 2 trades a month means nearly $200 annually in commissions alone. That's money that could have been compounding in your portfolio year after year. To combat this, educate yourself on brokerage platforms that offer commission-free trading for exchange-traded funds or ETFs, which are excellent low-cost investment vehicles. Be mindful of unnecessary trades, as every buy and sell chips away at your capital. And critically, be aware of all potential fees your chosen brokerage charges, including those often buried in the fine print. By being vigilant about these seemingly small charges, you can prevent them from eating into your investment returns, particularly if you have a frequently traded or diverse portfolio. However, sometimes the biggest drain isn't a fee at all, but the investments themselves. Next, let's confront the cost of bad investments. Poor investment choices within your RRSP, whether due to a lack of thorough research, chasing speculative trends, or making emotional decisions during market volatility, can lead to significant losses that completely offset any tax benefits. This is a crucial distinction. Unlike non-registered accounts, where you can often claim capital losses to offset gains elsewhere, losses within your RRSP cannot be used this way. Imagine pouring a significant portion of your RRSP into a single high-risk sector or a highly speculative stock that then drops by 40%. You've just lost a substantial amount of capital within your tax-advantaged account, and there's no immediate tax relief for that loss. To protect your hard-earned money, diversify your portfolio across different asset classes, industries, and geographies. Stick to a well-researched long-term strategy and, crucially, avoid making investment decisions based on fleeting emotions or hype. Smart, diversified investments protect your capital and foster consistent growth, maximizing the power of tax-deferred compounding within your RRSP. But even with smart investments, there's an invisible thief at work. We have to talk about inflation's invisible tax. Inflation, the steady rise in the cost of goods and services, silently and relentlessly erodes the purchasing power of your money. What seems like a comfortable sum today will buy significantly less in 20 or 30 years when you actually retire. It's like watching your retirement fund shrink, not because of fees or bad investments, but because the value of each dollar is slowly diminishing. Picture a $1.2 million RRSP in 25 years. Assuming an average 3% inflation rate over that period, that substantial sum will only have the purchasing power of roughly $600,000 in today's money. Your seemingly large nest egg could be effectively cut in half, leaving you with a lifestyle far less comfortable than you envisioned. To fight back, ensure your RRSP investments are growth-oriented enough to outpace inflation. This typically means investing in diversified equities, real estate, or other growth assets rather than solely relying on low-yield savings accounts or fixed-income investments that often barely keep pace with or even fall behind inflation. Investing strategically against inflation protects your future purchasing power, ensuring your retirement lifestyle isn't severely downgraded. And speaking of avoiding problems, there's a simple mistake many Canadians make that costs them dearly. This brings us to the over-contribution nightmare. Accidentally contributing more to your RRSP than your allowable contribution room results in a costly penalty of 1% per month on the excess amount. This penalty continues to accumulate until the excess is either withdrawn or new contribution room becomes available. It's an easily avoidable mistake that can sneak up on you. For instance, an accidental $4,000 overcontribution that remains in your RRSP for just 6 months will cost you $240 in penalties, not to mention the administrative hassle of correcting it with the Canada Revenue Agency, or CRA. Many Canadians, especially those with fluctuating incomes or multiple employers, can inadvertently stumble into this trap. To completely avoid this headache and unnecessary financial drain, always track your RRSP contribution room diligently. The most reliable way to do this is through your My Account, which provides your most up-to-date contribution room. Make it a habit to check it before making any significant contributions. Avoiding overcontributions saves you from costly and easily avoidable penalties, keeping your savings efficient and compliant, and ensuring every dollar works for you, not against you. And while we're on the topic of compliance, there's another mandatory event that can shock Canadians in retirement. Let's talk about the RRIF conversion shock. By the end of the year you turn 71, your RRSP must be converted into a Registered Retirement Income Fund, or RRI. This isn't optional. And here's the part that catches many off guard. From age 72 onwards, you must withdraw a minimum percentage from your RRIF each year, and these mandatory withdrawals are fully taxable as regular income. Failing to plan for these mandatory RRIF withdrawals can mean a sudden, large tax bill if your income, combined with these forced withdrawals, pushes you into a higher tax bracket. For example, if you have a $600,000 RRIF at age 72, the minimum withdrawal rate is 5.28%, meaning you must withdraw over $31,000 that year, all of which is added to your taxable income. This can significantly impact your tax burden. To avoid this unpleasant surprise, start planning your RRIF conversion early. Consider strategically withdrawing smaller amounts from your RRSP before age 71 if it makes sense for your tax situation. Also, optimize income streams with your spouse, if applicable, to smooth out your overall tax burden in retirement. Proactive RRIF planning minimizes unexpected tax shocks and helps you manage your retirement income much more effectively, ensuring your golden years truly shine. But sometimes the biggest cost is simply not knowing your best option. This brings us to the opportunity cost of ignorance. This hidden cost isn't about paying money, but about losing out on potential gains by not understanding when other registered accounts, like a tax-free savings account, TFSA, might be more beneficial for your specific financial situation. Or perhaps missing out on optimizing your overall contribution strategy between different account types. For instance, if you're currently in a lower tax bracket but anticipate being in a significantly higher one in retirement, contributing to a TFSA, where withdrawals are tax-free, might offer more tax flexibility than an RRSP for a portion of your savings. Many Canadians simply default to an RRSP because it's the account they know, without considering if it's truly the most tax-efficient vehicle for their unique circumstances. This oversight can cost you significant tax savings over your lifetime. To avoid this, educate yourself on the fundamental differences between RRSPs and TFSAs and how each interacts with your current and projected income. Better yet, consult a qualified financial planner to determine the optimal strategy for your unique tax situation, income trajectory, and retirement goals. Choosing the right savings vehicle based on personalized advice maximizes your overall tax efficiency, keeping more of your hard-earned wealth in your pocket. But the ultimate hidden cost, the one that dwarfs all others, is far more insidious. The ultimate hidden cost is often the most overlooked: procrastination and poor planning. The biggest hidden cost isn't a fee or a tax trap, but the immense lost potential that stems from delaying your contributions, failing to create a coherent financial plan, or simply ignoring these hidden costs altogether. You are literally missing out on the incredible, life-changing power of compound interest.
Think about it. Starting to save just $250 a month at age 25 instead of waiting until age 35 can mean an extra $250,000 or more by age 65, assuming a modest return. This isn't magic, it's the pure, undeniable power of compounding over those additional 10 years. Every day you delay, every year you avoid making a concrete plan, you're not just losing a small amount, you're forfeiting hundreds of thousands of dollars in potential growth that could have built the retirement of your dreams. To combat this, start saving for your RRSP now, even if it's a modest amount. Create a comprehensive financial plan that addresses all these hidden costs and commit to reviewing your RRSP performance and expenses at least once a year. Acting now and planning thoughtfully unlocks the full potential of your RRSP, securing a significantly more comfortable and flexible retirement. Every hidden cost you identify, every fee you challenge, and every strategic plan you make today isn't just about saving money, it's about reclaiming your financial independence. It's about ensuring that your hard-earned money works tirelessly for you, not for hidden fees or unexpected tax bills. Your financial freedom isn't a distant dream, it's a tangible reality built upon a series of smart, informed choices. Remember, knowledge truly is power, and taking action on that knowledge is what transforms it into prosperity for your future. You have the power to change your financial trajectory starting today. If this video opened your eyes to the true, often invisible costs of your RRSP and empowered you to take control, don't keep this vital information to yourself. Hit that like button to support financial literacy for Canadians. Subscribe to our channel for more crucial insights designed to protect and grow your wealth. And in the comments below, tell us, which hidden cost shocked you the most, and what's one immediate action you'll take to safeguard your RRSP? Your input helps us create even more valuable content for our community. Don't let these invisible drains sabotage your golden years. Take back control of your RRSP, understand its true costs, and diligently apply these strategies to build the retirement you truly deserve. Imagine the peace of mind that comes from knowing your financial future is not only secure, but optimized for maximum growth. Your future self will profoundly thank you for taking action today. The journey to a wealthy, worry-free retirement begins with informed choices, and now you have the essential tools and knowledge to make them a reality. Your financial destiny is in your hands. Seize it.